What happened in the silver market over the past few days isn't just another volatile move you can dismiss as routine noise. It's the kind of moment that forces you to stop, look twice, and question whether the number on your screen actually reflects reality. Because while the visible price was falling sharply, something very different, almost contradictory, was unfolding beneath the surface. In a span of just 60 days, China imported roughly 790 metric tons of physical silver. That translates to about 25 million ounces of real metal that has to be mined, transported, refined, and physically stored. This isn't a paper position, not a futures contract, not a synthetic exposure created inside a financial system. This is tangible silver moving across borders and into vaults. And it happened at the exact same time the quoted market price dropped aggressively, closing near $67. $69 after a sharp one-day decline of nearly 7%. Pause on that contrast for a moment. One of the largest sovereign accumulations of physical silver in nearly a decade is taking place, while the visible market price is being pushed downward in a fast, concentrated move. Those two facts don't comfortably coexist under a simple explanation of supply and demand. They point to a deeper structural dynamic, one that separates what the market says from what the market does. The decline itself wasn't gradual. It wasn't a slow bleed across several sessions. It was abrupt, directional, and intense. Silver dropped quickly toward the lower end of its weekly range, triggering stop losses and forced liquidations along the way. Gold also fell, but at roughly half the rate. That divergence matters. When silver falls almost twice as fast as gold in a single coordinated move, it often reflects not organic selling pressure, but concentrated activity in leveraged paper markets. The explanation offered by mainstream financial media leaned on familiar narratives: geopolitical developments, easing tensions, central bank messaging about interest rates, and shifting macro expectations. But when you place those narratives next to the scale of physical accumulation happening simultaneously, they begin to feel insufficient. They don't fully account for the magnitude or the timing of what just occurred. To understand why, you have to separate two different markets that are often treated as one. The price most people see, the one quoted on screens and charts, is largely determined in the paper market. This is a system built on contracts, not physical delivery. The overwhelming majority of these contracts never result in any metal changing hands. They are traded, rolled over, or settled financially. The price, therefore, is a reflection of trading activity in financial instruments, not a direct measure of physical scarcity. The physical market tells a different story. If you actually try to buy silver, coins, bars, or rounds, you encounter premiums. These premiums represent the gap between the quoted paper price and the real cost of acquiring metal. Right now, that gap is not small. It ranges from several dollars to well over $10 per ounce, depending on the product. That means while the screen might say $67, the actual cost to obtain physical silver can easily land in the 70s or even low 80s. That difference is not an anomaly, it's a signal. It reflects real-world supply and demand conditions: fabrication costs, inventory availability, distribution constraints, and immediate demand. When premiums widen during a price decline, it suggests that physical demand is not weakening alongside the paper price. In fact, it often indicates the opposite. Now layer China's activity into that picture. Importing 790 metric tons in 2 months is not a casual adjustment. It's not a marginal increase. It's a decisive move. To put it in perspective, that amount is roughly equivalent to the entire annual silver output of the United States. In other words, one country absorbed in 60 days what a major producing nation generates in a full year. That scale matters because it represents a direct removal of supply from the global system. Every ounce imported is an ounce no longer available elsewhere, and when that removal happens quickly, it tightens the balance between supply and demand, even if the paper price doesn't immediately reflect it. But the story doesn't stop at accumulation. At the same time, China has been increasing its physical holdings. It has also begun tightening controls within its domestic precious metals market. Restrictions on leverage, crackdowns on speculative trading practices, and efforts to reduce synthetic exposure all point in the same direction: a shift away from paper-based participation toward a more physically anchored system. This combination, buying physical metal while limiting reliance on paper instruments, is not random. It suggests a strategic alignment. On one side, there's accumulation. On the other, there's a gradual withdrawal from the mechanisms that allow prices to be heavily influenced by leverage and synthetic supply. The implications of that shift are significant. The current global pricing structure depends heavily on paper markets, where large volumes of contracts can be created without direct linkage to physical metal. This structure allows price movements to be amplified, accelerated, and at times disconnected from underlying fundamentals. If a major participant begins stepping away from that system while simultaneously increasing physical demand, it introduces tension into the framework. Over time, that tension can lead to divergence. You can begin to see two different realities emerge. one defined by financial instruments and another defined by physical transactions. The widening premiums already hint at this divergence. They show that the physical market is not fully aligned with the paper price. The gold to silver ratio adds another layer to this analysis. At current levels, it suggests silver is relatively undervalued compared to gold. Historically, when that ratio compresses, silver tends to move more aggressively. Even a modest shift in the ratio, without any major move in gold, implies a higher silver price than what is currently quoted. And again, the physical market appears to be pricing closer to that implied range than the paper market does. All of this is happening within a broader macro environment where questions about currency stability, debt levels, and monetary policy continue to evolve. For countries holding large reserves of foreign assets, particularly those denominated in currencies subject to expansionary policies, diversification into physical assets becomes a rational consideration. Silver, with both monetary and industrial characteristics, fits into that framework. It's also important to recognize silver's industrial role. It is not just a store of value. It is a critical component in technologies tied to energy, electronics, and infrastructure. Demand from these sectors is not easily deferred. It is driven by production schedules, contracts, and long-term development plans. That means a significant portion of silver demand operates independently of short-term price fluctuations. When you combine industrial demand with sovereign accumulation and a potential structural shift in market participation, you begin to see why the current moment feels different. It's not just about price volatility. It's about the alignment of multiple forces that don't usually converge so clearly. The sharp drop on Friday, viewed in isolation, might look like a typical market correction. But when placed alongside the physical data, the policy direction, and the broader demand landscape, it takes on a different character. It begins to look less like a reflection of weakening fundamentals and more like a manifestation of how the current pricing system operates under stress. This doesn't mean the paper market disappears overnight. It remains deeply embedded in global finance. But it does mean that its signals need to be interpreted carefully, especially when they diverge from physical realities. The price you see is not always the price that matters. Right now, there are two numbers to pay attention to. One is the quoted price on the screen. The other is the actual cost of acquiring metal. The gap between them is where much of the story lives. It reflects the friction between a system built on leverage and one grounded in physical constraints. China's recent actions amplify that friction. By increasing physical imports while tightening control over domestic trading practices, it is effectively leaning into one side of that divide. It is prioritizing tangible assets over synthetic exposure, and it is doing so at a scale large enough to influence global flows. Whether this leads to a rapid repricing or slower, more gradual adjustment remains to be seen. Markets can sustain disconnects longer than many expect, but they cannot do so indefinitely when underlying conditions continue to push in a different direction. What makes this moment compelling is not just the data point of 790 metric tons, it's the context around it. It's the timing, the policy backdrop, the premium structure, and the behavior of related markets. Together, they form a picture that challenges the simplicity of the current price narrative. So when you look at silver today, the key question isn't just where the price closed, it's what that price actually represents. Is it a reflection of real supply and demand, or is it the outcome of activity within a financial system that operates with its own rules? The answer may not be absolute, but the divergence between paper and physical markets suggests that the distinction is becoming more important. And as more participants begin to focus on that distinction, the balance between the two could shift. For now, the data is clear. Physical metal is moving in large quantities. Premiums remain elevated. Policy changes are underway. And the visible price is telling a story that doesn't fully align with any of those factors. Understanding that gap, recognizing it, questioning it, and watching how it evolves is what turns a moment like this from noise into signal.